I'm Charlotte McLeod with investingnews.com, and here today with me is Lobo Tiggre, CEO of independentspeculator.com. Thank you so much for being here. Great to have you.
Always a pleasure, Charlotte.
Really nice to be catching up with you in person once again. And we're going to look back at our last conversation, which was all the way back in July, the summertime in Florida. So at the time, you're talking about how you were right about 2024 being the year for gold, but it wasn't moving for the reasons that you thought it would. We were talking about this shift in global portfolio allocations. So are we now, toward the end of the year, starting to see the reasons you were originally bullish come into play? Yes. Okay.
So I have to be fair, base the data and say, I did call for undeniable recession by the end of this year. Not a lot of this year left. And it's looking like it may not be undeniable. Now, that doesn't mean there's no recession. We've had the so-called rolling recession. We've had the manufacturing recession, transportation recession, commodities recession. And since we spoke last summer, we've had the cracks in the labor market not only appear, but widen. And that's really significant. So, it's interesting to me that it hasn't become undeniable yet, despite that. Maybe Lynn Alden is right with her fiscal dominance thesis and, the fiscal side swamping what they're doing on the monetary side at the Fed. That could explain it. But I haven't quite given up yet because those cracks did appear right on schedule, and they have been widening. I mean, the last U.S. jobs report was basically a disaster, and it was written off as, it's because of a disaster, twin hurricanes, But you don't go from 250,000 new jobs, and by the way, revise those down, right? And then go from that to almost nothing, 12,000 jobs, just because a hurricane hit some states, not the whole country. So I'm very skeptical of that. And not to wax too rhapsodic on this, but what I'm saying is that weakening data is there. It hadn't become, an undeniable recession that everybody has admitted to yet, but the data is there. It is supportive to gold. Meanwhile, the central bank buying that helped gold take off before, like I was right before I was right, if you will, a lot of that was the central bank buying. And it's really interesting to me that has not gone away, but it has cooled off. And yet here we are still near nominal all-time highs in gold. It's over 2,700 again as you and I speak. Whereas after the election, the little correction we had there were a lot of people saying, it's going down to 2,500, it's going lower. So it's quite striking to see that the bid is still there for gold. And I think it's partly because people see what I saw. The reality is that the global economy is definitely weakening. China is struggling to hit their goals. Europe is... There's a world of hurt over there, and it's not just Germany and their automakers. And that leaves you with American exceptionalism, which has rested on this pillar of the U.S. labor market. So it's really telling to me that last report, hurricanes or not, was terrible. And if the next one comes out and it isn't immediately much better, that should sound undeniable alarm bells. We'll see whether that happens or not. The answer to the question, though, is the reality is there, it's happening, and you can see gold doing well despite the pullback in the central bank buy.
Right. So you had written, I think in your latest weekly newsletter that goes out on Saturdays, that this upcoming jobs report is the make or break for the hard landing scenario. So what are you going to be watching? Anything else that we should keep an eye on there? And how will, I guess, your thinking change depending on what we see?
I wouldn't hang it entirely on one single data point, but I'm trying not to be mealy-mouthed here and hedge my words and try to give myself an out. No, I made a call, and it will be right or it will be wrong. And I do think that data point will be potentially a coffin nail or a rung up on the ladder for my thinking. So I'll be looking at that. If you want a sneak peek, it's a funny thing that over the last few years, the ADP private payrolls comes out 2 days before the big jobs number from the government. And for whatever reason, it seems to often go in the opposite direction. I don't have math on this. I don't have a correlation number to give you to your audience, but I've just noticed this, and I need to go and do the math because I've noticed it, and it happened again this last time. ADP was up, and we got 12,000 jobs on the government, right? So for what it's worth, it might be something if you want to do a short-term gamble on the markets. Look at the ADP report, and if it's way down, the pattern would be that actually the jobs report will surprise to the upside. If it's way up, then we might get a weaker. I mean, it shouldn't be that way. It doesn't make sense unless you think about all the government jobs and so on. But yeah, interesting thing. That would be another data point I would look at. The ongoing jobs claims numbers, the weekly numbers. There's a really interesting pattern there. The initial claims is the number everybody looks at. When it comes out, Wall Street reacts to that initial claims number, but it's much more volatile. The 4-week average is obviously a smoothing number, but the continuing claims number, I think, is more important. I mean, it's one thing if you get fired or quit or whatever, you lose your job, you file a claim, and then you get another job, then there's much less impact. So that's less important. If you continue to file, if you're having trouble getting a new job, that's much more economically significant. So if you look at it, the jobless claims number, the initial has gone up and down. It's somewhat still elevated. It's backed off in the last few weeks, which doesn't fit with my hard landing thesis. But if you look at the continuing claims number, it's been going up and up and up for 3 years, and with some volatility. But it just hit a fresh high. So whatever the weekly noise is, we're accumulating a wave, as it were, of people who are having a hard time finding another job. I think that's significant. So, yeah, it's kind of nervous to be at the make or break point for a thesis, but I'm not going to punt. I'm not going to say, recession next year. Oh, no, the year after that. Either I'm right or I'm wrong, and I think the data points immediately ahead should be decisive.
Okay, well, we'll keep an eye on that. I'm sure we'll check in after it happens and see which way did it go. I think we also have to bring up, of course, since we last talked, we've had the U.S. election. So we have Trump coming in for a second term next year. Does that change your outlook on the U.S. economy?
It matters to me as a human being. It changes my outlook on a number of things. On the economy, no. I mean, yes and no. I'm not saying it makes no difference, but both candidates' agendas were inflationary, and I think we talked about that. It's somewhat amusing to me that the mainstream media all jumped on this narrative that the Trump agenda was more inflationary than the Harris agenda, which is, the Republican was more inflationary than the Democrat. It's kind of funny just because it's been the opposite throughout relevant history. But to be fair, when you promise all kinds of goodies and all kinds of tax cuts, that's, that the deficit has to balloon, and that, they say they don't monetize it, but they do. So I see where they're coming from and why people have said this. But either way, it was going to be inflationary. The one, maybe for me as a resource speculator, the one big difference would have been that Biden was more visibly pro-nuclear than Trump. And so as a person who owns uranium stocks and thinks that uranium is going up next year, if I was only voting for my portfolio, not as a human being, I'm a Puerto Rican, so I can't vote anyway for president. But if all I cared about was uranium, I would have voted for Harris. But it's interesting now that it looks like Elon's whispered in Trump's ear, and he has said more pro-nuclear power things recently than before. On the Rogan show, he conflated nuclear electricity generation with nuclear weapons, talked about how dangerous it was. So those kinds of things didn't really make me, on that basis, a Trump fan. But it looks like Elon sort of nudging him in the right direction, and he has now said more pro-nuclear things. So no, I don't see much difference there. The maybe takeaway here is, though, that we're looking at the appointments or the nominations for these key positions, which takes us from the realm of campaign promises, which, of course, campaign promises. But now we're looking at who he's picking and what that says about the agenda. Having a fracking guy at the energy department is good. Some people say, isn't that bad for uranium because all he'll care about is net? No, this is a sensible business person who seems to be reality-based, understands the industry. I think that's good for all forms of energy. Drill, baby, drill is not bad for uranium. There's not enough. We need more power. I just saw a chart put out by, I don't remember if it's Bloomberg or one of these Wall Street shops out there. But a chart showing the increasing energy demands in the U.S. and globally, and then with the AI slice added on top, the latest height. And what's striking about that is, as much as the AI is increasing the demand for electricity, the demand without it, no AI at all, is still huge. And I'm not talking 2060, I'm talking this decade, 2030. The demand increase is enormous. And, they can drill, baby drill all they want, but it's not going to be enough. And the windmills are certainly not going to be enough. Nuclear needs to be part of that mix. So, basically, I'm being long-winded here, but I saw both as inflationary. I still see both as inflationary. That's good for anything real, including real estate, but commodities, physical things, and especially including monetary metals, gold and silver. So, hasn't changed my thesis. I look forward to seeing what he actually does as opposed to what was said on the campaign trail.
Yeah, it's nice to have this conference so soon after the election so we can talk about these things, but all the answers I'm getting are kind of like, wow, we're going to have to wait and see on what really ends up happening. Okay, so that was a broad question, so we got a big answer. We will go on to talk about uranium. I don't want to leave gold behind quite yet, though. So gold, I'm starting to see among our audience questions about where are we in this cycle. And I know you don't do price predictions, so we're not doing a price prediction, but we're trying to think about where are we in the cycle so people can know, how do I position myself when it comes to gold?
Right. I don't think we've peaked yet. The potential for near-term correction is not done yet, I think. We saw gold kiss 2,800. It went over 2,800 on the futures contracts, and then it pulled back. And there were a lot of people saying, oh, it's going down to 2,500, it's going lower, this is the big correction. And, some corrections, some bumps on the road are normal to be inspected, but I couldn't see the bear case for gold in the near term, especially with, the inflationary candidate and the more inflationary candidate. And gold leads inflation. And the geopolitical strife. I mean, there was I couldn't see a card in the deck that was bad for gold. So I bought the dip, and I encouraged my audience to buy the dip. And here we are back up at 2,700 as you and I speak, so I'm feeling pretty good about that. But where do we go from here? That's the money question. So near term, I don't know. Volatility could be good, bad. I mean, Trump is nominating some pretty shocking people, and I could see that if they get in and they start shaking things up, while long term, that could be the deregulation and the liberalization of the U.S. economy could be a very good and constructive thing economically. The initial pain of transition, if Elon and Vivek get in there with Javier Milei's chainsaw and start chopping out bits of Washington left and right, I'll cheer as a human being, but it will be disruptive. And, that shock could send all kinds of things bonkers and haywires. And the near term is highly variable in my view. Safe haven demand could be good for gold. Anyway, I guess I'm just saying I don't know near term. But longer term, I think we have higher to go. Depending on how fast it gets there, I'll be very surprised if gold does any serious retreat before we hit 3,000 per ounce. An actual nominal all-time high, we've done that repeatedly, but a real all-time high would be over 3,400, pushing 3,500 right now. So with all these crazy things going on in the world, we haven't actually even hit an inflation-adjusted high yet. So I'm not too nervous about gold. I do see upside in it. And I see near-term weakness as a buying opportunity. Once we start getting in the realm of a real all-time high, well, then I got to have a different conversation.
I'm sure if we get to that point, we will be talking. And so gold and silver stocks on your shopping list or not?
Still
on the shopping list. Okay.
In fact, my most recent purchase was a silver stock. Before that, it was gold. Before that, it was uranium. So I still like all three of those. Just briefly on silver, I was asking the audience this question. I'm bullish on all of these, But it's hard to see gold doubling from here without some huge blow up in the world. Like, if gold doubles from here in 2025, that's probably because either Europe or the Middle East went nuclear, or something really horrific happened. So as a human being, I don't want that to happen. And if it doesn't happen, I don't see Trump beginning his inflationary work, taking gold that high over the next year, right? So if the question is, which one has more upside? Whereas a double in silver from 30 to 60, that's a lot, but it's not like gold having to go over $5,000 an ounce. So it's easier to see more upside volatility in silver, and silver bulls will always tell you that silver lags gold at first and then more than catches up in the end. And in fact, we saw that the last time Trump got elected. By the way, the last time Trump got elected, gold and silver sold off at the beginning, just like this time. Gold dropped until close to when he was actually sworn in. And then that was the market bottom, which we've never revisited since then. It just went up and up throughout his term and then beyond. We have never gotten to the low that gold put in right after Trump was elected last time. Silver did the same thing, but then it just struggled for years, and it didn't catch up until the end of Trump's term. I'm not saying that has to happen again. I'm just pointing out, even silver bulls will tell you, silver tends to lag gold at first, right? So, but it's more volatile. It's easier for me to see silver doubling than gold from here, but you know what? It doubles a lot. Even a 50% increase, that would be $45 silver. That's much easier to see hitting than $60 silver within a year. So we'll see. I like them both. I'm more nervous about silver because of its industrial aspect in the near term, but I'm willing to buy both if I can find a compelling value proposition.
Okay, good to go over those ones. And we'll go now over to uranium. So uranium stocks on the shopping list. I don't think we spent a lot of time on uranium when we talked in the summers, and probably today is not the time to spend a huge amount of time on it. But I do want to check in and see where you see it going. I think people after this year of, that $80 to $85 kind of range are looking at it and getting a little impatient, which of course we shouldn't be impatient, but that's
great news if you're a buyer. Like, if you remember in 2022, when I famously got eggs thrown at me here for saying that uranium was my top pick instead of gold, right? That was fantastic. People got bored. People started hating uranium again. It hasn't done anything for 9 months. Like 9 months was somehow important. So we're in a similar situation. Uranium went up to 106. It corrected. That was easy to see coming. And the optimists didn't want to see it coming, but there it was. The important things are that's normal. There's nothing bad. Nothing has changed fundamentally in the market. The fundamentals are better almost literally every day, if not certainly every week. There's some new announcement, some new restart. Japan accelerating its restarts. The United States is restarting nuclear reactors. This thing with Microsoft and 3 Mile Island, that was an eye-opener. Wow. But besides the wow factor, it's just sort of the regular drumbeat of China building more and more and more of these things, in India. And so the demand is just going up and up. And, we don't need the AI height on top of that, but it doesn't hurt to have that too, right? And all of this is extremely bullish. The key points are the correction was to be expected after a hockey stick move. Spot got way ahead of long-term contract price, which is the real price, if you will. So it was no surprise to see it come back. And by the way, it corrects, and where does it stop? Right about where it hits the long-term contract price. That has served as a floor now for over a month or two. I don't remember exactly where they hit, but that has supported it. And long-term contract prices are still in a rising trend. So I do expect uranium to go higher. I think all the market action we've seen is normal. The one other takeaway would be, even though I think uranium's going higher, again, could it double the next year? That would be a lot. $160 uranium, that's a tall ticket. Or even a 50% increase from here, that's a lot. I think it will track upwards with long-term contract price. We don't need it to double, though, is another takeaway. This price that we have right now It's enough for the better uranium miners and the better projects to get built. There's money to be made whether or not uranium goes any higher at all. Of course, it helps if it does, but I think there's money to be made right now in space, regardless.
Okay, and I'll do one uranium follow-up question. So, long-term contracting. I have heard that utilities haven't been very active in the market this year. They're kind of off the sidelines. They're taking a break as the price is taking a break. So is that what you're seeing? And when they start to come back, I guess what would make them come back in? Many nuances.
Well, the answer to the second question is they have a spreadsheet and it tells them how much inventory they're required to have on hand. And so when they have to buy, they have to buy. The answer to the first question, I might punt to Justin. I mean, he's the uranium insider. He's on the phone with these guys all the time. He could tell you more about that. I would just say as a general market resource guy who is long uranium, that the trouble with long-term contract prices is it's so opaque. We find out about it after the fact. And people keep saying, and I see this on my X, Elon feed all the time, oh, well, why doesn't anybody even pay attention to spot price? It's not real. It doesn't matter. Everybody knows long-term contracts, all that. Yeah, but a spot price is something that you can quote all day long, right? The long-term contract price we find out about later. We can see what Cameco said after the fact and so on. So we have neither the transparency nor the frequency of the data. So we have to pay attention to spot. And the spot certainly moves our share prices. So you can say, oh, yeah, forget spot. It's not important. But that's like saying, okay, well, forget the speedometer. I don't need to know how fast I'm going or something. This is a data point we have to pay attention to. So my takeaway answer here is I can't tell you what's going to happen next. I can tell you that the trend, whatever the volume is and whatever the utilities are doing, the trend is still upwards. The long-term contract price trend is upwards. I see no reason for that to change. And we will know in the next quarter. And then the one after that, where we're at after that. I expect it to be higher, even if on less volume.
Okay, all right. And I probably will go back to Justin in the near future. We'll see what he's thinking on uranium. Okay, so that's a nice little wrap up of some of the things that we usually talk about. But we are heading into a new year. And you told us in 2023, that would be the year for uranium. 2024, the year for gold. That turned out both pretty well. So I think you've been revealing here what is 2025 the year of?
I thought about silver. As we were just talking about, it's easier to see silver going up, say 50% or even possibly a double. That would be a reach, but it's easier to see than gold, much easier to see than uranium. But actually, I had to go with copper. For the reasons that I just cited, silver's volatility, its tendency to lag. For 2025, I'm not sure that this is the year for silver. And it's easier for me to see copper going up 50% or even a double from here. We've got a squeeze. We've got projects that are late, or we've had nationalizations. We've got delays and extensions. We've got permitting problems. You get roadblocks. Because theoretically, the copper market is close to imbalance right now. And then the supply shortage that everybody's been talking about, that grows over the years and decades to come. But theoretically, right now, it's theoretically not like this huge shortage. But the problem is reality is never like the theories. Mines always take longer to build up than you expect. They cost more, they're late. And like I say, we've got shutdowns and roadblocks and nationalizations and all these problems with supply. Meanwhile, demand is doing that. So the odd thing is that I'm still expecting, as we started this conversation on the macro, bad economic news in the near term. So I'm looking for the call for copper is both on odds and magnitude. Like, I think that it's easier to see and highly likely to see copper moving higher next year. But I'm not rushing out to buy yet because I think even in the little time we have left this year, we're going to see more bad economic news. And Dr. Copper, with the PhD in economics, always goes down with that sort of news. So I'm looking to that as a buying opportunity. I'm looking to maximize my upside by taking advantage of that. If I'm wrong, then the bottom is now, and I should be buying now, and I will miss that. If I'm right, though, I'll make a whole lot more money by being a bit patient. So what are my risks here? If I'm wrong, I missed the bottom. It's not like I missed the whole boat. With this copper thesis is really a multi-year, potentially a multi-decade thesis because of the structural supply constraints that it faces. So if I miss the bottom, I'm not too worried. Whereas if I buy now as a newsletter writer with 30,000 best friends looking over my shoulder, right? If I buy now and it goes down 50% next month, I'll hear about it. So, and also just as a person who's trying to make money, right? I don't know where the bottom is, but the odds feel to me, scientific statement there, feels to me like the odds are that I'll have a much better entry point just ahead. So I'm willing to wait a bit for that. And if I'm wrong, I'll just buy anyway.
Okay. So we're set for 2025. I will hope for 3 years in a row of correct.
Crossing my wolf claws.
Fingers crossed. And I think you answered my question, which was, before when we talked about copper, it was you weren't going to touch it until after recession times. But I think based on this conversation, it makes sense why now.
Well, it's actually the same message. What I'm saying is, I said before, I won't touch it until I'm sure the recession has done its worst. What I'm saying is we're now at that point where either the recession that's about to happen, we're about to see that, or I will be wrong. And if I'm wrong, I'm wrong. Then I need to adjust my strategy. If that's not going to happen, then I don't want to, wait like Linus in the pumpkin patch. I'll admit I'm wrong and I'll adjust and I'll start buying.
Okay. Yeah, the Great Recession pumpkin. Okay. I will wrap it up there unless you had any final points to leave people with.
I guess just one more thing on this copper thing. This was the takeaway that the audience data here. I asked the audience, what would make me wrong about copper? It's not this recession call now. It's the demand. It's the inflationary argument. It's the structural supply constraints that, the world needs more and more copper, and we're not discovering and we're not building the mines fast enough. And it looks like that's hitting the road now. So what would derail that thesis next year? What would make me wrong about copper in 2025? It would take like a real recession, not just, the numbers are bad and let's throw the money helicopters at it. It would take the government saying, we're in a recession and that's okay. We're going to let it burn. The market needs to correct the excesses of our predecessors. And I just don't see any government. Not the Europeans, the Chinese are trying to stimulate as much as they can, package after package after package of stimulus. And I certainly don't see either candidate previously just letting the U.S. burn and suffer in pain. The moment there's signs of pain coming, the stimmy checks fly, is my view. So in that world, the data point was, I asked the audience, 500 people in the room, whatever it was, does anybody think the powers that be will see a recession rear its ugly head and just let it ride and let it happen? And not one single hand went up. So it's not just tinfoil hat Lobo here. Like the entire audience could not see that happening. And that is the only scenario I see that would be bad for copper in 2025. So 501 people voted in favor of this thesis this year, for what it's worth.
Okay. Well, we'll leave it there. Thank you very much for coming on this very quick tour through all the different commodities. We'll catch up with you hopefully again soon.
Thank you, Sean.
Okay. And once again, I'm Charlotte McLeod with investingnews.com, and this is Lobo Tiggre with independentspeculator.com.